Hey, welcome back to Right on the Money, your go-to resource for the financial topics that matter to you. Now, if you're just joining us, one, you need to go back and check out the first episode because we're here with Fred Griffin, founder of Silas and Ward Financial Group. Fred, great to have you here, sir.
Great being here with you, Dennis.
You know, there's a myth out there, Fred. I know you're more than familiar with this, but a lot of people expect taxes to go down in retirement. Why do so many retirees, especially federal workers too, why do they get caught off guard?
One, because none of us have control of what the tax rates are. That's a legislative decision. Taxes, the marginal tax brackets, they either reduce, stay the same, or they increase. People don't recognize because most of us, not many of us, let's put it that way, were living in 1940s or early 1940s, and we definitely weren't adults if we were. But the marginal tax bracket right now is 37%. The highest marginal tax bracket at that time was over 90%. Could we go back to 90%? Who knows?
Exactly.
Who knows? Who really knows? Yeah, I mean, just look at the worst case scenario. Here you are, you're about to retire, you planned on your tax bracket being where it is now, and it increases 10% or 15%. Could it happen? Yes, it could happen.
What do you think is the biggest tax surprise? Is that it, the assumption that it's going to go down? It seems like it does catch people off guard.
That's exactly right. People assume it's going to go down. People assume they're going to make less in retirement, and that's not always the case. I mean, usually, especially in the federal government, because you find workers, for instance, some of my clients, they have a pension from the military. Then they have a pension now from the federal government, and they have their TSP or their retirement funds. They're drawing, many of them have other investments. So they have all of these sources that they are pulling income from or that they were not pulling income from before. And many times what they end up finding out is that their retirement income is equal to or sometimes surpasses their income. And then take on top of that, many of us have special skills now, and they go into a new career, running a business or being a contractor or a consultant. So they create another stream of income. So income planning and tax planning is a big part of what we do.
Is it true that a lot of like pensions and the 401k money and the money coming out of, say, IRAs, that's all taxable? And so it's a little different. So it's taxed like ordinary income, or how does that work?
Yeah. I mean, it depends. You know, the question is, do you have your money in a traditional IRA, which many older, most people, a lot of people have quite a bit of their money in traditional IRAs, or is in a Roth. And so was the money already taxed like Roth? And then when you start taking your income during retirement, that income is tax-free. But if your income is tax-deferred or in traditional retirement account, once you start taking income, that income will become part of your marginal tax bracket. You will be taxed as income.
A lot of moving parts there.
Yeah. But they're important to know.
How do WEP and GPO, how does that complicate Social Security for Fed employees?
Well, it complicates it because many times if you're taking income from a source, are you receiving a pension? This was when it goes into play, when you're receiving pension income. Let's say you're receiving pension income from a source that you did not contribute Social Security. Let's say that you're an expat and you're receiving a pension from a foreign country. Well, you didn't really contribute to Social Security in the United States. Or let's say that you were part of the old retirement plan where it was a civil service plan and there was no contribution to Social Security. Then you went back into the workplace, or you previously were in the workplace, but you still qualify for a Social Security income. That's the tricky part. If you qualify for Social Security income, and then you're receiving Social Security income, but you're also receiving income from a source, a pension from a source that did not contribute to Social Security. Social Security will, that's the WEP, that's the windfall provision, elimination provision. It will reduce your income. It will adjust your Social Security to make sure that you're not overpaid in Social Security.
What mistakes do people make? You hear these things, Roth conversions, TSP withdrawals, and if I'm not mistaken, there's survivor benefit elections that, especially federal employees
Sure.
and people with pension, they can only select once.
Yeah.
Talk about you see some common things out there that you got to help people with?
Yeah, I can start closer to home. My father, my father was an entrepreneur, and but he was also a soldier. He was a soldier, and so he qualified for a pension with his military. He was Army vet. He was wounded in battle, and he qualified for a pension, and because this pension, at the time, I found out that after death, the decision he made, they give you two choices. When you have a retirement pension, you have a survivor, you have a benefit for a single income or a joint income. And if you choose the joint income, the income is less. But what happens, whoever the first to die, if your spouse is still living, that income at a maybe a reduced rate, it will carry on for the remainder of their life.
So if you go single and you pass away, then it stops, and if you do joint,
it stops immediately. So my mother had to deal with the loss of her husband and the shock the next morning that the income stopped because he chose a higher income.
My goodness.
And not really probably thinking out what will happen. And I've had that happen. I've had even in retirement plans, some of my other clients who, not just my mother, but my mother wasn't a client, my father died before I was in this business. So I don't want to discredit myself to say why wasn't my father a client?
Sure.
He died. My father died right at the same year. I became a financial advisor in March of 1999. My father died January the 20th, 1999.
Oh my goodness.
So he made the decision. I was an insurance agent, but I didn't have the expertise and the knowledge that I do now. But some of my clients have actually been in situations where they had to make decisions in a nick of time and convert to another retirement plan because the one they chose previously only had individual pay instead of a joint pay.
That's
and so they were able to catch it, and at a consequence.
Whether they're a federal employee, whether they're a member of the general public, you help people retire on both sides of that world. Best way to get a hold of you?
Email is always great because it's permanent.
Yep.
It's permanent, but a phone call or email, we don't miss either one. Both of those are great.
We're going to come back on the other side of the break. We're going to talk about legacy. We're going to talk about maybe controlling things beyond our time here on Earth. So remember this, if you like the show, please do us a favor, squeeze the like button, click subscribe. That way you will not miss a single episode. We'll see you right back here in just a second.